We learned a lot with coronavirus about how the U.S. Treasuries become the favorite buy on the street and across the globe as rates are pushed down. So between the Fed, who's bought 70% of new Treasury net issuance since October, all the negative rates across the globe, a major flight to safety harbor, but yet through all that, it seems to not really pay much attention to economic fundamentals of the U.S. Is the yield curve or interest rates truly an economic indicator of any validity anymore?
Well, I think that is a question that a lot of people are asking themselves now. As you point out, there are a lot of non-fundamental factors that are at work, flattening and maybe even at times inverting the yield curve, central banks, asset purchases, regulatory requirements that are putting pressure at the back end of the curve. And I would add to that list shifting demographics. With an aging population, you have an increasing number of investors that are looking for a safe place to put their money over the medium to long run. And I think that's also influencing the shape and slope of the yield curve.
And it makes the Treasury, or excuse me, the Fed and all central banks' job nearly impossible. You know, they don't like an inverted curve, but should they keep lowering rates on the front end based on investor appetite around the globe due to mistakes by other central banks? Does that make sense?
So central banks, I think, are kind of stuck in the middle. You know, on the one hand, they look at inflation and they're disappointed with it. On the other hand, they have these extraordinary forces we were discussing that are holding down the long end of the curve. And so, you know, they're reacting to it as best they can. I think the big question is whether, you know, how much force their policies can have in this environment.
And I think that is the main question, actually. You know, Japan and China are net sellers, but does it really matter? Everybody else in the world seems to be net buyers.